It can't be turtles all the way down. There has to be a pool at the bottom. And,
oh, man. I'm using that as the teaser quote for this episode. Welcome back to episode 46 of Acquired, the podcast about technology acquisitions and IPOs. I'm Ben Gilbert.
I'm David Rosenthal.
And we are your hosts. Today we are covering an acquisition that the tech audience cares a lot about, even though it's not really a tech company. Nestle's acquisition of Blue Bottle. So
shockwaves have gone through Silicon Valley.
Yes. There have been lines around the block that are forming their own lines around the block just to hear the news.
So great. Where will the VCs and entrepreneurs congregate now?
Yeah, I mean, what's the sort of like islandish one?
Phil's. Yeah.
Well, fourth wave of coffee.
Fourth wave. We'll get into it.
We will.
All right, listeners. Now is a great time to talk about a new partner of ours here on Acquired, Legora, the agentic operating system that is redefining how the world's best legal teams work.
Yep. It's sort of obvious that AI is going to completely change the legal industry. I bet most of you listening have dropped a contract into some sort of AI chatbot out there. Legora took that insight and asked the question, what if you really built something with that power from the ground up for the legal industry?
So the founders did exactly what great founders do, operate with obsessive customer focus. They embedded inside a massive law firm for months. They sat with the lawyers just watching how the work really gets done.
And that's how you get features that customers love, like tabular review, where you drop in a folder of hundreds of contracts and it pulls every key term into a grid a lawyer can actually work with. Legora's bet here is interesting. Since it lets each lawyer handle more complexity, any given person can increase the quality of their work and do higher value work. And this means that the pie can grow even as each individual task takes less time.
And they recently launched Legora Agent, offering greater intelligence and performance. The agent lets lawyers set an objective. Then it can handle the planning and the execution and delivery of the final product. Legal teams get to maintain full control and transparency since they're still involved where judgment is required.
And Legora works where you already work. You can use it within Microsoft Word while redlining or drafting. The early Legora numbers essentially speak for themselves. When they have a head-to-head pilot with their top competitor, they win 70% of the time. Legora now has over 100,000 lawyers on the platform from 1,200 legal teams in 50 countries. And crazily, they went from 1 million to 100 million in ARR in about 18 months.
Truly insane numbers. And that is the real test. Plenty of things demo well, but the question is whether a busy associate actually reaches for it during crunch time, or whether a partner trusts it before going into a conversation with a major client. If your legal team wants to check it out, whether you're a law firm or you're in-house at a company, you can learn more at legora.com/acquired and just tell them that Ben and David sent you.
All right. Well, David, that's all I've got for pre-show.
All right. Well, before we dive in, I was thinking about this episode, and it's kind of funny. We've got these series of like mini series here on Acquired. We did the Disney trifecta, and then the fourth, of course, with BAMTech. We've done sports. We did the LA Clippers. That was out there, but fun. We've done a bunch of gaming episodes. And now we've got our second coffee episode on the heels of the Starbucks episode. So,
well, this is a primarily Seattle dominant podcast, so we do have to do multiple coffee episodes.
Next, we'll have to do the Seahawks next.
Yeah.
So coffee. We talked quite a bit in the Starbucks episode with Dan Levitan about waves of coffee and the parallels between the coffee world and the tech world. And we alluded to third wave coffee, which really is kind of the reaction to Starbucks. Starbucks being second wave. If the first wave was kind of Folgers and Maxwell House and brew at home coffee, the second wave being Starbucks, an experience, a place you go to. The third wave is really all about the quality of the coffee. People, it is really the origin of hipsterdom. Starbucks sucks. It's super corporate. We're going to focus on the artisanal quality of...
It's burnt. It's dark. It's, no care put into it. It's a factory. Everything is made exactly the same. Call it operationally efficient and praise their business model, or, hate on it because it's systematized. But it is definitely a reaction to the mass market success of Starbucks.
Yeah. And so third wave places like a Counterculture was one of the first in Durham, North Carolina, Stumptown and down in Portland, which is now owned by Pete's, interestingly, or Intelligentsia, which I think started in Chicago, is also now majority owned by Pete's. Cafe Vita in Seattle, all these folks, they really focus on the drink itself, and probably arguably nobody focused more on the drink than Blue Bottle. So let's dive into Blue Bottle. So it was founded by a very interesting guy named James Freeman, and highly recommend. We'll link to this in the show notes. But he did the Stanford Entrepreneurial Thought Leader talk. He gave a talk there last year. Really fun to listen to. He basically, let's just say, he starts it with an analogy to Merce Cunningham and John Cage, the sort of avant-garde, modern dance choreographer Merce Cunningham and his partner John Cage, who is an avant-garde musician, and their work together as an analogy for his whole talk. And then he goes on to quote Sartre and Proust. Very philosophical.
Honestly, David, one of my favorite things about this show is learning about the insane and talented and driven people that start these companies. There are no normal people that start enormous companies.
No. And James is no exception. He, unlike most of the founders we talk about, he's definitely not an engineer, not even remotely connected with the tech world, except for the fact that he lived in the Bay Area. He was a freelance clarinetist, a classical musician who played the clarinet. And he did that until his mid-30s. And then he kind of woke up one day and he realized, I'm never going to be the best clarinetist. And maybe I should find something else to do with my life. And what else could he do? Turns out he had this side hobby of roasting his own coffee beans in his oven at home. So he would buy beans and he would roast them at home in his kitchen, in his oven. Apparently made lots of smoke, and his wife at the time was not a fan of this hobby. But he made these beans and he would drink the coffee himself and he would give it to his friends, and people loved it. And he thought, well, maybe I'll turn to coffee for my life. So he started in the early 2000s. He quits the music world, and he lived in, I don't know if he actually lived in Oakland or if he started the company in Oakland. He was living in the Bay Area, starts Blue Bottle in Oakland. And the original business plan is that he's going to keep doing what he's doing, and deliver beans to people's houses. These great beans that he's roasted, in his kitchen the day before, will deliver them to his friends' houses. So it kind of sounds like an on-demand startup.
Truly,
he was ahead of his time.
And hilariously, that the part of the business, fast forward a little bit, that they operate now, that's a coffee delivery service. They acquired another company to do that called Tonks, when they sort of moved into a bit of a different sector.
Yep. So he's sort of the company is back to its origins now with that acquisition later. But he does that for a little while, and then they kind of realize like probably not going to become a really large business if he's roasting coffee in his own kitchen.
And it's hilarious following the parallel to Starbucks. Like both started with this model of beans only, and selling those and focusing exactly on that, and then realizing, boy, there's this whole other retail coffee experience to be created.
Yeah, exactly. And Freeman, sort of similar to the Starbucks story, where it wasn't the Starbucks founders who realized that there was this retail opportunity. It was Howard Schultz. Freeman himself kind of stumbles into it. So in 2003, he signs a lease for a roastery so he can get it out of his kitchen and start roasting in a commercial space. And then it's not until 2005 that he actually opens up his first retail location, which is in Hayes Valley in San Francisco. And it's in a friend's garage. So he has a friend who loves his coffee. And his friend has this garage on a little side street in Hayes. And says, why don't you come open up a kiosk and actually, instead of just selling beans, sell coffee there? James is excited about this, and his sort of approach to coffee, even though the name Blue Bottle comes from Blue Bottle Coffee in Vienna, which was one of Europe's first coffee houses, he's actually more influenced by the sort of Japanese style of coffee. So whereas Howard Schultz was influenced by his time in Italy and the Italian coffee houses, the whole approach at Blue Bottle is very, very Japanese centric, and the Japanese approach to coffee is very third wave. It's all about the very, very meticulously crafted, perfect cup of coffee. And James talks about this in his ETL talk at Stanford, that part of his inspiration is this coffee shop in Japan, where the first thing you do, that the barista does when you order a cup of coffee, is they have a wall with all these cups on it. And the barista, he or she will go look at the wall and decide which cup, they're all different, is perfect for you.
Wow.
And so that's the inspiration for Blue Bottle. And if listeners, if you've been to Blue Bottle, if you live in the Bay Area, I'm sure you have, or travel there often. This is the anti-Starbucks. It is very austere. There is very little in the locations except for the coffee. There's no Wi-Fi. There are no power outlets. They do have some food, but very little. It is truly all about the coffee. This idea of the cups, James also talks about much later in the company's history. They had cups specifically made for Blue Bottle. These are ceramic, to stay cups. They don't like doing to go cups.
Of course they do.
That are the cups are perfectly sized. They're not perfectly round, but they are sized exactly for the size drink that you get at Blue Bottle. There are no sizes. You just get, you order whatever it is you order, and it's one size.
David, I can't take it.
It's so hipster. The synergies with the tech community are just too perfect.
So you pay software engineers more money and more disposable income, and they want to be better than everyone else, and they want to buy more pretentious things. They love coffee. They need coffee to be productive. I know.
I'll sell them really expensive coffee that they don't have to think about because they're thinking about writing the code. So we do the thinking for them, but it's really good.
Exactly. It's like the Steve Jobs one outfit, reduce cognitive load thing.
Exactly. I mean, that is Blue Bottle, which is very different from Phil's, which we'll come back to in a minute. Phil's is the competing Bay Area chain.
I should say, Blue Bottle is freaking amazingly good. The
coffee is really good.
I'll rip on it for this whole episode, but it's an unbelievable product.
It really is. I mean, you can't be from Seattle and not appreciate good coffee, and it is very good coffee. So after the kiosk, the first very little store in Hayes opens up, it really starts to take off. It spreads kind of by word of mouth. They start to open more locations in the Bay Area. Then they go to New York City, they go to Los Angeles, and then they go to Tokyo, to Japan, and the sort of inspiration for all of it. And so there's stores in all of these cities now. But they start to grow fairly rapidly. And in 2008, so this was very early in kind of the rise of sort of the modern startup and VC industry. I mean, arguably, even maybe I would say before lots of capital, the sort of modern Series A and beyond type startup, they raise a venture round, and they raise $5 million from a firm called Kohlberg Ventures and Chris Sacca and Lowercase Capital. This is just when Chris is getting going.
That dude gets into everything. Unfreaking believable. The nose on Chris Sacca to find those early stage.
Amazing. It was a $4 million fund. Just so tiny by today's standards, but he was in everything. Blue Bottle, Uber, Twitter, and then
many, bought
many
up
more.
A bunch more of Twitter that he could on the second market.
So $5 million round from Kohlberg and Lowercase in 2008. Then a few years later, in 2012, they raise a $20 million round led by Index Ventures and Google Ventures, and then a whole bunch of other individuals. So Kevin Systrom, a number of other tech CEOs, Tony Hawk, the skateboarding legend, invests. I mean, this coffee. I mean, this is the thing. I think we might have talked about this a little bit in the Starbucks episode. You're literally selling drugs to your customers.
Oh my god! I was doing some. One of my favorite things to do research for this podcast is to go look at all the Quora responses to reactions around the deal and sort of tease out what I think is a great point and, you know, things I want to bring up on the show. And there was one really great quote that I was going to wait to say later, but I think is worth bringing up now from Daniel James on Quora. In this $20 million round, the question was something around like, you know, why is Blue Bottle getting all this investment? What are the VCCs? And he goes, coffee is a legal, addictive, unregulated, psychoactive drug with cheap ingredients, premium pricing, and a huge worldwide growth market. Blue Bottle is a quality brand with a good team and a strong history of well-managed growth. To me, this seems much better than a VC bet with many consumer internet companies.
I know. And it's so funny. I mean, I actually think, and I remember this round, the 2012 round, nobody really paid attention to the 2008 one, but the 2012 round was like, you know, it was sort of similar when we were starting Rover and people are like, this is a sign of the apocalypse, like Airbnb for dogs. Like, who's going to use that? It was the same thing then. It's like, what are these VCs thinking? Like, they're investing in a coffee company. And to be clear, like, there was never any even pretense that this was like going to be an internet company. It was like, you know, James and Blue Bottle, they're like, no, this is a coffee company. we make coffee. We have stores. People come, they buy the coffee, they drink it. Like there's, you know, we have a website, but like
reduce COGS and like lower variable costs. Like, nope, none of that.
No. This is a coffee company. And people were like, why are these VCs investing in this? Turns out they did well, and particularly that round did very well. But we'll come back to all that.
It is worth pointing out, like, this super interesting near self-fulfilling prophecy of this. The sort of Twitter family and Blue Bottle was joined at the hip very early, and they got a lot of sort of because they were both, at least very early on, incredibly product-focused companies with like sort of super tasteful visionary founders. Like they attracted the same sort of people, and they magnified each other. So you look at like Sightglass, that was a couple of early Blue Bottle folks that left to start their own thing. Like they co-founded that with Jack Dorsey and was an early pilot for using Square at that location. And you see the types of people that were attracted to Blue Bottle as a product and as a lifestyle and put money into it. I mean, it is like they just won over the most valuable segment as customers and then brought them on as investors.
Yeah. And this is something, I mean, we've talked about this on this show before, but like, especially if you don't live in the Bay Area or in Seattle or LA, or, you know, you're not kind of in the ecosystem, it's easy to forget. You know, you read about these companies in the press, they become so valuable. They're almost like these celebrities. Like, these are real people, and these companies exist in real locations. So I don't know if it was the second, but the first sort of canonical Blue Bottle store, you know, larger than the kiosk that was in Hayes, was in Mint Plaza. And Mint Plaza is like 2 blocks away from the Twitter building. So like, well, you know, where do all the Twitter, you know, employees go when they want coffee? Like they go to the Blue Bottle in Mint Plaza. And it's just like these ecosystems, like everybody's right there. And that's how these things sort of feed on one another.
I thought about this as like a customer acquisition strategy of if you have a company and you want people at another company to buy it for B2B purposes, like buy all the Facebook ads of the employees at that company so that you can like get their attention, even outside of typical channels. Like if you aren't right next to the Twitter building, but you're interested in doing, attracting Twitter people, could you target them all over the place digitally as well as having a physical location there? Because I feel like while Blue Bottle sort of pioneered that, I feel like that's no longer novel to put something right outside of a company that. Anyway, to put a physical location there.
It's interesting. that growth hacking tactic doesn't work anymore.
Could you be digitally close? Yeah.
Yeah, seriously. But it definitely worked for Blue Bottle. And I think Biz Stone was an investor. I don't know if Ev Williams was. I don't think, Jack was obviously an investor in Sightglass, a competitor, but it worked. So 2014, they then raised another $25 million. And then in 2015, they raised $75 million from Fidelity. And that was like, wow, this is like a lot of money from like a real, public markets investor. And then they keep expanding, within those cities that I mentioned before, but grow to, over 30 stores throughout both the country and in Japan. And then in surprise announcement in the middle of September, on September 14th, 2017, it is reported that Nestle comes in and the large conglomerate and buys out a majority stake in the company for a reported $425 million. We don't know the exact number, but it's been pretty widely reported that they paid about $425 million. And that was for 68% of the company. So they bought out the investors, and James and the rest of the management team are keeping their stake. So they keep 32% of the company, its own separate board, but all the investors are bought out. So the valuation on the company is $625 million, assuming that the $425 million figure is correct. And here we are.
Pretty amazing. I mean, I wonder, the first thing that comes to mind is, did the founders keep all their shares? Was there a little bit of a secondary there where they took money off the table? They had to have taken something, right? Like they had to...
I don't know for sure, but they may not have. There had been some secondaries along the way. So I believe some of the money from some of the later rounds was secondary sales that the founders and management team were taking money off the table. So I actually don't know in this case whether Nestle paid out anything to any of the employees.
Yeah. Well, I will say, as I, for lots and lots of reasons, believe that full acquisitions are better than these sort of majority buyouts, particularly for startups like this. I mean, they're a 40-store retail location, but early-ish, mid-stage company. But if you're going to do it in this manner, where you're not acquiring the entire company, I love the idea of it running independently and the founders still having a ton of skin in the game to make this thing, grow in valuation. There's sort of an interesting thing of like, it has to stay a separate company. Like think about this. How, if you're those founders, do you think about how your shares get valued now? Like there's not really a competitive market to do the next round. It's not going to, there's not a market to value your company. And it's certainly not anywhere near getting valued on a reasonable sort of price to earnings ratio. So are you hoping that at some point Nestle just decides to buy you out? Is it actually in their best interest to do that? I love the incentive. I'm curious on the mechanics of how that works.
I think you're hitting on all the right questions here, Ben. I think part of the reason this happened as it did is, I have to wonder, I don't know anybody at Blue Bottle, personally, but Freeman and Brian Meehan, who's the CEO, he came in and took over as CEO a number of years ago, but Freeman's still very, very involved. They both were very vocal about saying they never wanted to go public. They didn't think being public made sense for Blue Bottle as a company, and it also just was something they weren't interested in. And yet the company continued to grow, but But at the same time, they'd raised all this money. And in particular, in some of these later rounds, I'm bringing in folks like Fidelity. Like Fidelity is a mutual fund. They're a public company investor. Like they want a return. All the investors want a return, but particularly them. And they want liquidity. And so I can only imagine the tension that must have been building as they were making these decisions to take these partners on along the way, these partners as investors, who just had sort of fundamentally different goals than what it sounds like James and the team did.
Yeah. Okay. So here's the question is, did that dichotomy just continue to grow and grow and grow where they were diametrically opposed to going public? They were taking on investors that needed them to go public or needed to have a big liquidity event and in a reasonable time frame. And like they sort of were in a rock and a hard place.
Yeah. I mean, that is the question. And I think the question for both for Blue Bottle and for us in terms of, and this show, like looking at what's going on in the tech world, like Blue Bottle, we were joking in the beginning of the show that it is unapologetically not a tech company, but this type of dynamic is rampant these days. I mean, so many founders of tech companies have raised all this money and yet are, adamant that they never want to be public. And that a lot of them also say they don't want to sell the company either. So like, what are you going to do?
Yeah, I mean, seems like that would have been a nice thing to be aware of upon investing.
It does seem that way. It does seem that way. And it's so funny. It's also so...
is that lip service, David? Like, is it like how if you want to run for president, you're supposed to say, like, I'm not interested in being president, and then, like, you reluctantly do it so you don't seem power hungry? Like, is it like, oh, we never want to sell out, and then, like, you inspire your employees and you're mission-driven forever, and then until the day that it happens, it's never going to happen?
Yeah, I don't know. I mean, you could say so, but then like, we've talked about this in so many episodes, whether about Snap or about Facebook, these companies, the majority of them, obviously not Snap and Facebook, but have been private for so long now, and they just keep staying so, Uber, Airbnb, all these companies, many, many others, certainly could be public companies and probably should be, but the founders are, for whatever reason, either delaying or even, saying they don't want to. But I think it also, like, there's a tension here. I mean, on the one hand, I think we've been painting it for the last few minutes as bad, or at least that this is a disconnect, which it is. But on the other hand, if you go back to sort of what Blue Bottle is and this whole third wave of coffee, which we're using as an analogy for, the state of the tech world right now, does it make sense for Blue Bottle to be a public company? I mean, it makes sense for Starbucks because Starbucks' goal is to be everywhere and on every corner. But if Blue Bottle's goal is to be about the cup of coffee and what is actually in the cup, does it make sense to be as big? I don't know.
Yeah, I mean, Blue Bottle has 40 locations, right? Like they have plenty of growth ahead of them if they want to. I mean, Starbucks has 24,000 locations. You don't need to be a public company to be a 40 location coffee shop. I'm actually very curious too. They also have this online business selling directly to customers. I'm super curious what the revenue mix looks like. I would suspect a lot more of it is either buying coffee in the stores, in liquid form, or buying the beans in the stores, and then the online subscription business is smaller. But interesting to think about that too, because then you start to think about it. Still not an internet company. Like, I'm really sick of the fact that like, oh, we sell it online and like people subscribe to it. Like, that's a slight business model shift, but ultimately like fixed costs, distribution costs, like still not an internet business. But then you at least drift closer to something where you're like, okay, this is different than all the brick and mortar stuff that exists today.
All right, listeners, now is a great time to tell you about a longtime friend of the show, Vanta. AI has scrambled the whole security picture. It used to be that you proved that you were secure once a year, an audit or a static PDF, then everyone would nod and you're done. But in an AI-first world, that doesn't hold up anymore.
Yep, your risk surface changes every week now. A vendor turns on an AI feature or someone writes in a new model without telling IT, and your posture is different than it was last week, let alone at your last audit. Vanta's own research found that around 70% of companies have this quote unquote shadow AI running with no security review at all.
Right. And that's where Vanta comes in. They're the leading agentic trust platform, meaning they've built the thing that closes the gap. And the way that they close that gap is Vanta Agent. Think of it as a GRC engineer, that's governance, risk, and compliance, except that it's software and it doesn't sleep. It finds the issues, drafts the fixes, and cuts the time that you'd spend on vendor assessments in half.
In half! Which is exactly why more than 16,000 companies today run on Vanta. Companies like Ramp, Cursor, and Snowflake all stay audit ready and catch the risks that crop up between audits across every vendor, every AI tool, the whole environment.
And that's the real value. Trust has to be continuous now, which is why Vanta automates your security, your compliance, and the work to earn and prove trust. We're huge fans of Vanta over here, and literally hundreds of acquired listeners have become Vanta customers at their companies over the years. So you can get $1,000 off Vanta at vanta.com/acquired. That's VANTA.com/acquired for $1,000 off. And just tell them that Ben and David sent you.
We've posed some questions here, and I think James Freeman and the Blue Bottle team were very clear what side they came down on those questions, which was that Blue Bottle can't be a public company and maintain its ideals, and also that it's not an internet company. But I do think, in terms of where I come down on this, like, I'm not sure that that's the dichotomy that makes sense, right? Like, I think about Apple, right? Like, an Apple store and a Blue Bottle store are eerily similar. And Apple is maintaining
what Apple Store used to be anyway. Like, I think the days of believing that an Apple Store is a sparse, simple location is far over.
Well, no, but you walk into an Apple Store and you can count on, well, you used to be able to count on both of your hands the number of products they were selling there. It's more now, but it's certainly not relative to the number of square feet that they have. The number of products that they're selling is way smaller, but that has been able to scale and touch just about everyone in the world. Whereas, as you point out, and Blue Bottle has 40 stores.
I'm curious to get into acquisition category because I'd love to get your take here. Do you want to dive into that now?
Yeah, let's do it.
All right. So I'm curious what you think. The thing that I have bolded in my show notes of our categories, people, technology, product, business line, asset, or other, is product, because they are this, it's a really fantastic product, a lot of care in every cup, truly differentiated in terms of, once you have it, you kind of want to go every day to that. You don't want to go for anything less. Do I think Nestle could create that? Probably. Like, do I think they could create that for way less than they paid for Blue Bottle? Certainly. Would it be successful? Almost certainly not. Like, I think ultimately what they've bought here is the brand and the prestige around the brand. And they're going to try and leverage that into all sorts of, I think they're going to try and leverage that into all sorts of interesting ways of, using their supply chain to really amp up the growth rate of Blue Bottle, to potentially sell other stuff in Blue Bottle, to sell Blue Bottle coffee everywhere where they have store space. But they bought brand here. They bought coolness.
Yeah. See, I was going to go business line because, yes, there are all those things that Nestle could do with Blue Bottle, but there's such a risk if they do that they destroy the brand, right? And I don't know that Nestle, I don't know the full ins and outs of their corporate structure, but I don't think they have anything quite like Blue Bottle, which is like a physical retail experience. So this is something kind of new and different for them. But I think you also raised a great point that, like, this is a business line, but it's not one with a ton of crossover. Like, there's crossover potential, but there's so many landmines in there.
Yeah. I don't think I really considered that much. The question is, if it's a business line, then it should be freestanding. And that means that you should believe that the sum of future cash flows on this thing are going to be $625 million. That's a lot of growth.
Yeah. But, on the other hand, so they I'll foreshadow. We'll get into this more in tech themes. But this really is kind of like, it's so interesting. Like this is a like Facebook style acquisition being done by Nestle, right? Like they're keeping the team separate. All the rhetoric is that, they're going to let Blue Bottle just keep doing its thing. It's a separate board. The employees and James, the founder, still own a significant chunk of the company, separate from Nestle. Yeah. But I don't know. What do you think? Is it going to work?
Well, I mean, so what are they going to do? The question is like, what are they going to do with it? Are they going to try and put Blue Bottle in more places? Because I believe Nestle can probably do that. Like if that's the goal and, it's really just create a ton of the exact same Blue Bottle experience in more places. Yeah, they can probably do that. And a big capital infusion is a really good idea to do that.
Yeah.
But I was reading this interesting.
Nestle can be a much larger capital provider than even, however much money Blue Bottle could raise as an independent company. Even they raised $75 million from Fidelity, but
100%.
Like Nestle could write that in a week,
Right. So I was reading this interesting Quora post that's like, it gives a good order of magnitude for what individual cafes sell. And I feel like I should have gotten the Starbucks comp because that would have been better. But this says in Australia, 60% of cafes sell between $200K and $2 million per year. So let's say that on the revenue side, that's $2 million of revenue per store that Blue Bottle generates. Like that's a lot of stores to get to $625 million.
Mm-hmm. Mm-hmm. Well, and it's not just revenue. I mean, back to your point a little while ago, this is not a tech company. Like, let's say they have 40 stores doing 2 million of revenue in each. Right. Like, okay, they had 80 million in revenue. Like, let's say, but the margins on that are not software margins.
Right. I did read one interesting piece that I thought was pretty interesting that said that basically Nestle had to do something in coffee because they have dominance in Europe with Nespressos. And by the way, I have an espresso machine. We have one at work. These things are freaking awesome. 70% of the single serve market in Europe is Nespresso. And they tried to penetrate in the US and completely lost to Keurig and Tassimo. And they have less than 5% penetration in the US on those single serves. And so the question is, if they came out with a Blue Bottle single serve thing at home, would they be able to win some of that back? And the reason that it's important is because across Nestle's businesses, their margins are about 15%, and in their beverages, it's about 25%. So any way that they can make more of their business lines, beverage business lines, they can generate much higher margins, and this could be a huge missed opportunity if they have to forfeit the single serve coffee market in the U.S. as it just skyrockets in popularity.
Yeah, interesting. So this is like the this is bad, but like the right way to do the Juicero.
Yeah, actually, David, I tried the other day just squeezing my Nespresso pods, and they made amazing coffee on their own. I don't know what I paid the $100 for this thing for.
Yeah, well, you can't do that with coffee. So.
No, it is, so let's paint this scenario. If it is a separate business line, like this is a totally new thing that may or may not work, which is a leveraging of the brand into something that the brand may not be able to be leveraged into in the sort of single serve home thing. Like, would they pit Nespresso against Blue Bottle and have two divisions making similar things selling against each other? I mean, maybe it'd be the same division and they would just, sort of relabel the Nespresso stuff.
Well, if Nespresso, and I agree, they really do make good single serve coffee, much better than Keurig's. But if they have such small market share here, maybe they just rebrand the whole thing in the U.S. as Blue Bottle.
Yeah, I wonder. And how much of a say do the Blue Bottle folks have in that? I mean, presumably Nestle makes the decisions now and has the controlling interest.
Yeah, but again, remember, like they don't own 100%. Like the Blue Bottle team still, has a large stake. Like there's just a lot of complexity to this deal for so many reasons, as we've been talking about.
Yeah. I like your assessment of business line. I'm curious. I mean, it is that for now. I'm curious to see what sort of integration we start to see.
I feel like we've talked a bit about what would have happened otherwise, but I guess if Nestle hadn't come in and acquired Blue Bottle, and nobody else had for a while, I mean, what happens? So like Fidelity's sitting there on their cap table at a very large stake, and is, they're not in the business of owning, shares in private companies for 20 years. What happens?
Yeah, I mean, presumably another Nestle would have to come along in some amount of time. I mean, you can really see the dynamic here play out, right? Where the founders are like, we don't want to sell, and they end up keeping all their shares, and the Fidelities are like, we need to get out of this business. Like, we've seen great growth, but like, my God, we need a way to get out of this. You almost wonder, did Fidelity, tee this whole thing up with Nestle?
Well, and not just Fidelity too. I mean, don't forget, there've been VCs, on the cap table here since 2008. So almost 10 years. And, venture capital funds, have a life cycle. This is something that, I think a lot of people don't really understand, unless you're, an insider in the business. But the typical life of a venture capital fund partnership, limited partnership, is 10 years. And what that means is that from the time the fund was raised until, whatever that date is, and again, typically 10 years, like, you're supposed to wind up the whole fund and give all the money back to investors at that point. Now, in most cases, there will be provisions to extend the life of the fund. That almost always does happen. But still, then, as the VC, you're having to go back to your investors every year and keep asking for an extension. And eventually they're going to get tired and tell you no.
And then what happens, David? This is a good little VC 101. Like, what if the LPs say no, and there's still, shares owned of these private companies that haven't got liquidity yet?
Well, what would happen then is those shares would get distributed out to the investors in the VC fund, the limited partners. And that would be really bad for the company too, because now all of a sudden, instead of, XYZ VC, say, let's say, Index, right, who led the Series B in Blue Bottle. So instead of Index as your investor and sitting on your board, now ratably in proportion to those investors in Index, they all own like little bits of your stock now. And they're in totally different businesses. Like, they're not in the business of sitting on your board, helping you grow. They may have different liquidity timeframes, return hurdles. It just turns into a nightmare.
And so then you could have, 50, 100, 200 new entrants on your cap table.
Yep. And not just new entrants, but new entrants with wildly divergent, interests.
Right. And, presumably at some point that starts to trigger some things that need to happen with the SEC because you have so many shareholders.
Yeah. Now the rules have changed on that a little bit with the Jobs Act, but still,
no bueno.
Yeah, no bueno. So, I kind of think we talked about this before, but like, we're going to see a bunch of this in the coming years. Like, if some of these companies don't get public or acquired, like, there's going to have to be some sort of transaction that takes place. And maybe private equity is a path. So that might have been one thing that might have happened otherwise. You saw this with SurveyMonkey. So similar situation. The company was Dave Goldberg, Sheryl Sandberg's late husband, was the CEO, and he was adamant, never wanted to go public, but had raised all this money. And so actually several times the various private equity firms came in and bought out the existing investors in SurveyMonkey. And then even larger private equity firms came and bought out the smaller private equity firms.
There is a bigger fish for a while. At some point, they run out of big fish, and the public market is where you need to go.
It can't be turtles all the way down. There has to be a pool at the bottom. And,
oh, man. I'm using that as the teaser quote for this episode.
Love it.
Okay, one other VC 101 moment. So why not? So of course, every day is a day that goes by where it would be nice to have a return on your capital so you could invest it elsewhere. But why don't VCs more typically do an evergreen fund so they don't have these sort of artificial fund vintage triggers to force this to happen?
Well, some VCs do. So like Sutter Hill is an evergreen fund. The thing about that, though, is that everybody has to be aligned in the partnership, both the VC partnership and then the limited partners, about wanting that. So all of the limited partners have to be able to say like, yep, we don't care about timelines and liquidity. But then even more importantly, the general partners in the VC fund have to also be willing to say like, I don't care about liquidity either. And, most VCs, some are, very wealthy independently or have been VCs for a long time and have gotten liquidity and aren't as motivated. But really, if you look around the industry, especially in these multi-generational firms where the folks that are running the show or making investments now maybe aren't necessarily the founders, they're not, they're not in a position where they can just indefinitely go without liquidity either. So it really, and especially, as a VC, an investor in these types of companies, it's not like, if the company is generating positive cash flow, it's not like they're dividending it out to you. So, whereas if you're a founder of a company, you can do things, you can start to pay yourself a lot more. If there is cash flow, you can dividend it out, or you can do bonuses or whatnot. None of that money comes back to VCs.
Yeah. Great point. Well, thanks for sidetracking there with me.
All right, listeners. Now is a great time to thank our longtime friend of the show, ServiceNow. If you are running a large enterprise, AI agents are likely spread across every team, and deploying them is no longer the hard part.
Yeah. The hard part is knowing what permissions they have, what employees are using them for, or what decisions AI is making. AI security for an enterprise at scale is not a small concern. Like, the risks are real.
Exactly. And the challenge with AI is governing it, securing it, measuring it, and making sure that it actually delivers value. That is why ServiceNow built the AI Control Tower.
Yep. AI Control Tower gives enterprises a single place to see, manage, govern, and optimize AI across the entire business. And it works with any AI, not just theirs. Every device on your network, every permission across every system, every AI agent visible and secure in one place.
And ServiceNow can do this because they've spent more than 20 years building the operational backbone of the enterprise, the workflows, governance, approvals, security controls, and institutional knowledge that power how work actually gets done across IT, HR, customer service, finance, and security.
ServiceNow already runs more than 100 billion workflows annually and trillions of transactions for more than 85% of the Fortune 500. So when companies need a place to govern AI at enterprise scale, they're building on a platform at the center of how their business already operates.
And in a future that isn't going to be one AI, it's going to be thousands of AI agents working across every function of the company. But the question is, who's managing them all?
So if you're trying to turn AI ambition into real business outcomes and make it work safely, securely, at scale, go check out servicenow.com/acquired and tell them that Ben and David sent you.
All right. Should we dive into tech themes?
Yeah, let's do it. And here's one that I don't know if it's actually applicable, but I've been thinking more and more about. And I think what I'm going to do here is walk myself into a corner where I say, actually, this is not a tech theme for this episode, but the return of brick and mortar in a different way than it was used before is really interesting to me, where the story of the decade or the last 2 decades is Amazon taking 97% of retail growth, Walmart growing a little bit, and everyone else shrinking, and especially big box stores shrinking. And this return of kind of boutique retail, where even the online companies, Warby Parker, Bonobos, the sort of direct from internet to your doorstep companies, are opening stores. And in many cases, they're doing the stores very differently. So like, You go to the Warby Parker store, you don't actually buy glasses there. You buy them on the website in the store, but you can kind of try it on. It's more like, it's almost like a marketing expense, like a brand awareness expense, and a way to make the experience a little bit better. Now, as I said, I was walking myself into a corner. This isn't quite the case with Blue Bottle, but it is sort of part of this, boutiquification of retail away from the man.
To invoke Ben Thompson a little bit, like it is a little bit of aggregation theory in that what these experiences, new retail experiences, do have in common is they are a superior customer experience versus, you are going to Warby Parker for one specific thing. You're going to Blue Bottle for one specific thing. You're going to an Apple store for one specific thing. Like there aren't thousands of SKUs just lying around on the floor. And so as a result, you can have a much better, purer experience of that thing in that store. And as a result, you can, if you're able to get distribution, now this is where it breaks down a little bit in the physical world versus, aggregation theory on the internet. If you're able to have distribution wide enough and you have that superior customer experience, you will win every time. I mean, if there's a Blue Bottle next to a Starbucks, like I'm going to the Blue Bottle, But in the physical world, and I think this is also, Ben, what you were talking about in the beginning of the episode, like Blue Bottle's been valued like it, is an internet company, but it's not. Like they need to have a store everywhere to do that. And that's going to require a ton of capital.
Yeah, it's pretty interesting. I mean, the way I like to think about internet companies being differentiated is they super low, if not zero marginal cost. You can have super high fixed costs, but low marginal cost, especially not businesses like Apple that make hardware, but like internet companies. As you sort of look around at those businesses, they tend to be winner take all. Facebook is a winner-take-all business, and Amazon will be a winner-take-all business, and Amazon doesn't quite fit, but like maybe Amazon as the third-party seller group kind of fits. So the interesting thing here is like coffee stores are not actually winner-take-all. Like despite the fact that Starbucks, it's not just the internet that allows you to quickly saturate a global market. It's many other factors of our world today too. It's, our ability to do logistics at mass scale, our ability to do single advertising campaigns at large scale where you quickly make a brand understood by many, many people. So, it's slower than if it were just bits because it's in the real world. But, Starbucks, while expanding to a global market fairly quickly, 24,000 stores, it turns out there actually are segments. And it's not a one-size-fits-all for everyone to create the best experience. When you're in the real world, and maybe even when you're in software too, you can't create the thing that's best for everyone under one single company.
Well, you can though if you're a marketplace, right? Like, and I think that's why Amazon can be a winner-take-all business in retail, because like you can buy the, I don't know, what's some trivial example, like an iPhone dock, right? Like you can buy the, $3 iPhone dock from China on there. But you can also buy the like $500 artisanal, you can get your Starbucks and your Blue Bottle on Amazon.
Well, that works on a product perspective, but doesn't work in a physical experience perspective. Like,
yeah, exactly.
I mean, even if I could get exactly Blue Bottle coffee, like if I'm going to a Starbucks to get that, like it's not the same.
Yeah, right. So this is where, the analogy breaks down in the physical world.
It's kind of interesting. I mean, like if you go back to a traditional version of marketplace, like before it was this category of VC investable businesses, it was large square footage areas where multiple merchants were in a single place. And like Blue Bottle doesn't want to exist in a marketplace either, much like Southwest doesn't want to exist in a travel aggregator. Like I don't want to be seen around all that cruft. I want to be in my own little thing and separated from all that. So I guess the tech theme I'm going with here, or the theme I'm going with here, is like some things are uncram-inable into these business models that are massive and winner take all and look super shiny from an investment perspective. And I think coffee may be one of them. Like Starbucks is killing it. They're doing great. But like, are they the answer for everyone? No.
I certainly agree with you in coffee as it exists today. But I'm thinking about like Airbnb though, right? Like you couldn't, a Holiday Inn was very different from a Ritz-Carlton, right? There were segments there for sure, but both of those experiences, and both below a Holiday Inn and above a Ritz-Carlton, exist on Airbnb. A platform like that actually can, address, if not the whole market, many segments. Part of it's tied to maybe it's just the nature of the coffee market, but I think it is also tied to this like physical nature of these businesses. Like you can't do the same with coffee, right? Because the experience of sitting in a Starbucks is very different from the experience of sitting in a Blue Bottle. They can't kind of coexist.
Could Blue Bottle move down market at some point and open Starbucks competitors? And like there's Blue Bottle Classics, and then there's like Blue Bottle something new. And
what's interesting, Starbucks is doing this, right, with the roasteries. They're moving.
They're going up market.
Yep.
Well, and like, can Starbucks actually win over the coffee snobs? I mean, that's a tougher battle than like suddenly there being a $4 latte that's available from Blue Bottle in a larger location that has Wi-Fi. Like then I feel like I'm almost one of the cool kids, and I have the product that I actually want.
Well, maybe the way they have to do it though is what we were saying earlier, which is through the single serve packaged coffee.
I go through the home instead.
Yeah.
Yeah. Interesting. I mean, the whole, who knows what direction they'll go, but I'll put the flag in the ground and say I just don't think you can do a winner take all business and create that a product for everyone when you have to think about cramming in the physical experience of it too.
I can't think of an example that is not an internet business that can serve everyone. Like Google can serve everyone, and Facebook can serve everyone, and Instagram can serve everyone, and Airbnb and Uber. But
I mean, even actually not Instagram and even not Facebook. Like there's so many people that want to select into their social network because Facebook's too public for me, or Instagram's too limited. Or
good point.
I'd say we may be nearing. No, I'm not going to go there. Like the pushback of the one size fits all, but in some ways.
Well, okay. Well, maybe Amazon can, right? Like, who wouldn't buy from Amazon because it's on the
environmentalists?
Environmentalists, maybe. Yep.
I mean, I'm looking for corner cases in some ways, but do I believe that Amazon will be able to solve the problem of shipping products to environmentalists? Yes. Like that's a bet I'd make.
Yep. But I think you're onto something. Like it only works because you don't have to go physically shop at Amazon. Because before Amazon there was Walmart, right? But like there were whole segments of people that would never shop at Walmart. And likewise, there was whatever high-end equivalent of Walmart you want to pick that doesn't exist anymore.
Target.
Target. Right. Well, Target is sort of more, I think, more mid-market, maybe slightly upmarket. Certainly from Walmart, but I don't think it's like, the Neiman Marcus of big box stores. Just about every demographic, unless, as you point out, you have a environmental concern, would shop on Amazon, right?
Yeah, I mean.
Because again, you can get your $4 iPhone dock or your $500 iPhone dock there.
Yep. They're getting there anyway.
Yep. All right.
You want to grade?
Let's do it.
All right. You start because I don't know.
Well, this is tough. I mean, it's kind of like everything worked out here, right? Like investors got a nice return, especially the early investors. The management team and James, certainly seems happy. I mean, they're leaving a ton of skin in the game, so they must be bullish on the future. Nestle is getting they're getting a growing brand and a new business line to add, but they're also potentially getting something that could really be valuable to them in terms of rebranding their Nespresso single shot market, and that's a very big market. But there are these, like, it just feels like this whole thing wasn't the right fit, as we've had this discussion. I think I give it a B right now because like this certainly was like a good outcome for everyone, But I just wonder if it was like the right path, and what would have happened if maybe Blue Bottle had made some different decisions along the way.
I don't disagree. It does feel like my biggest takeaway is with the successful acquisitions we've seen, when you really dig in, you start to see like the one real reason this deal got done. And, with Instagram, it's like, oh my God, Facebook can unlock even more supply, like even more ad inventory, and push all of their advertisers into, a crap ton more ad slots. And
not to mention Facebook
that's what that deal is about.
And they had an existential threat in losing mobile. Like, it was very clear what it was about.
Right. And there's others, like there's you see exactly what what Disney wanted to do with Marvel, right? Like there's
the flywheel,
their business is turning super valuable IP into dollars in 11 different forms, and boy, are they firing on all cylinders of all 11 of those, pumping them into the Disney machine. And like, what I can't see here is like, what's the one reason they did this? Like, I think it's probably a good idea. Like, it seems like a good thing for Nestle to own. I can paint a story where the rebrand of the Nespresso makes lots of sense. I can paint a story where, instead of growing 50% year over year and projected to grow 70% year over year next year, like they actually really turn it on and are able to do, open lots more stores very rapidly because they have all this capital. But like, do I see the like one thing where this fits perfectly in and there's internal alignment within Nestle of how they're going to leverage this asset? Like, I don't work there, but probably not. Like, I mean,
I think the only dark horse being the Nespresso. That may just be a huge business, and they needed a way to invigorate it.
Yeah, thank you to the Quora commenter who suggested that. It's pretty interesting. So I'll go B-, maybe C+, but again, I think I've rated things that were way worse than this C's, so I'll go B-.
Carve out. So I was on a flight to Ohio this weekend and had lots of free time, was clearing out my Instapaper. And this really interesting thing, I first heard about it like 2 years ago, the Tulip Mania story. There was a Dutch tulip bubble where people were going insane for buying tulips, and it grew to a religious fervor where people were paying unbelievable amounts for certain special types of tulips, and highly speculative, I'm going to buy this bulb and it'll be beautiful in some number of years from now, and like total mania, right? The same way that we see bubbles that exist today. And it's kind of like the first macroeconomic bubble that people cite. And it, theoretically, like crashed the Dutch economy, and there was, incredible despair, and people lost fortunes and all this stuff. And the interesting thing was, over the last few years, I've actually seen more and more of this story pop up in more places, especially in the, technocrat sphere, where people love to wax philosophically about if we're in a bubble or not. There's even a movie coming out. I think it's Tulip Mania, or Tulip Fever or something that like this month. And the Smithsonian Magazine published a really interesting piece called "There Was Never Really a Tulip Fever." Oh, and I've heard about this.
It was super interesting. Like this thing that's gotten quoted and like referenced over and over again. Like, somebody wrote this book and did a bunch of research and tried to figure out, like, okay, let's, who were these people that lost their fortunes? And as they dug into it, they realized, like, of course there was over speculation here, and the people, a lot of like very wealthy people put lots of money in and lost that, but it never actually affected the working class, and it never actually destabilized the whole economy, and it didn't throw anything into like a tailspin. And it did not have these trickle down effects that are so often quoted when wanting to compare a potential oncoming bubble, or 2008 or 2000 to this Dutch tulip bubble. And it's like totally fascinating of analysis of why we wanted to believe that this mania created even more devastation than it actually did.
Interesting. Relevant to today's times.
Yeah. And there are some cool little takeaways in that and suggestions of why we do want to believe it, but I'd say I'll leave it to the author, who's way more eloquent at explaining that. So click the link in the show notes if you want to check it out.
Cool. My carve out today is actually random seeming, but is the iPhone SE Classic. So I watched the Apple keynote a couple weeks ago. We talked about it a lot on the HTC episode. It was really great. And, coming out of it, so I've for the last 3 years, I've been a Plus model guy. I got the 6 Plus and then I got the 7 Plus. And coming about it, I wasn't that compelled by any of the new hardware. Like, I see where they're going with the iPhone 10. It's the future. It's amazing. But I was like, I'm not ready just yet because AR isn't like real yet. It will be in the next generation or two. And then I realized I was looking at the iPhone 10 and I was like, oh, it is smaller. It would be nice not to have such a big phone in my pocket anymore. And then I just kept looking at my 7 Plus and I was like, this thing is enormous. And I can't sit down with it. And for the last 3 years, every time I've had lunch or dinner or gone out, I always put my phone on the table because I can't have it on my body. And so I was like, there's such an active liquid secondary market for Apple products. I just sold it on eBay and I got an iPhone SE on eBay for way cheaper. And I'm sure I will upgrade in the next generation, but I'm really happy to be back to having a small phone. I never thought I would say that.
This just in, venture capitalist decides not to partake in new high-tech technology and rolls back to the Stone Ages.
That's me. That is me. No, it's so, I'm always all my whole life I've been a bleeding edge adopter, but the form factor, I just kind of realized, again, maybe I'll probably change in a couple of years, but I was like, it's just nice to be back to, being able to have my phone in my pocket.
I'm envious. You're so right on that. I think were it not for these cameras and sometimes when I want two-handed use of a larger keyboard, I miss the crap out of that form factor.
Swipe glide typing though on the Gboard, the Google keyboard, is pretty good. And I think this is it for me. I'm not much of a photographer. I don't take that many pictures, whereas I know you do. So it was the appeal of the cameras for me is AR in the future, and I just don't think it's there yet. So I'm going to enjoy my 1 or 2 years, probably 1 year, with a phone in my pocket.
Well, David, enjoy your non-bionic phone.
I know I'm going to miss the bionic. Are you going for a 10?
I mean, if I can get one, I'm gonna dual wield and have my browser open and try and order online, and have my Apple Store app on my phone open and see if maybe I'll end up with 2. I don't know, but I bet I'm into Q4 if not or early Q1 next year.
Well, but this is the thing about Apple products, right? If you are an iOS person, there is so the secondary market is so liquid. You have to pay some transaction costs, but
it's crazy. It's not really not that much. And they keep their value incredibly.
They keep their value. Not you can swap out for really not much money in terms of economic impact. It's kind of crazy.
It is.
All right, listeners, now is a great time to talk about one of our favorite companies, StatSig.
Yes, long-time acquired partner. There is a reason why the best product teams at companies like OpenAI and Notion, Atlassian, Figma, Rippling, Brex, and more rely on StatSig, whether they are iterating on their core product features or shipping AI-powered experiences at scale.
Yep. In the crazy speed of today's AI world, shipping fast is just table stakes now. It's basically trivial to build and deploy your app constantly. The real advantage is how quickly you learn what changes actually created value for customers and how fast you can use that signal to guide what you ship next. Whether it's a feature tweak, a pricing change, a performance improvement, or an AI update like a model change or prompt adjustment, they're not relying on instinct. They're measuring what actually moved engagement, retention, and ultimately revenue. And as more teams build with AI, that learning loop becomes even more important. Building with LLMs introduces non-determinism into your product experience. The same input doesn't always produce the same output, and behavior can shift in subtle ways in real-world use.
So doing offline evals will give you part of the picture, but you can really only understand the impact once your product is live with real users, and then you can measure how their behavior actually changes. It's very different than the way that you would ship features in a pre-AI world where you knew exactly what the software was going to do in production.
Yeah, exactly.
So this is where StatSig comes in. It brings experimentation, feature flags, and product analytics into one unified system so teams can ship safely, test rigorously, and directly link what they changed to how users actually behaved. The result is a tighter feedback loop and learning that compounds over time, so you don't just ship more, you ship better.
So if you want to make learning your competitive advantage, whether you're building new AI experiences or just evolving your existing core product, go to statsig.com/acquired to get started.
Well, I think that's all I've got. Do you have anything else?
That's all I got.
All right, listeners, if you aren't subscribed and want to hear more, you can subscribe from your favorite podcast client. If you feel so inclined, we would love a review on iTunes. Other than that, join us at acquire.fm. You can join the Slack. And that's all we've got. Have a great day.
See you guys soon.